So hello everyone and welcome to the Carbon Conversation. My name is Miriam Vicente and I will be your host today. In this episode, we'll explore the intersection of finance, policy, and climate action. We will discuss the ins and outs of the roles of banks in the voluntary carbon market. So whether you are a policymaker, an investor, or just curious about how finance can help to fight the climate emergency, this episode is packed with insights you won't want to miss. To do so, today I'm joined by two experts on the subject, Arnold and Benja Faecks. Welcome to the podcast.
Hello.
Thanks for having us.
Before we jump into the specifics of why banks engage or do not engage in carbon markets, and what are the reasons for this, we will set the scene. We will talk a bit about what is the voluntary carbon market. I think, Benja, you can tell us about it.
The concept of emissions trading. So the basis of the voluntary carbon market is the trading of emission reduction certificates. Compliance markets are mandatory systems that are enforced by nations and by international agreements. And the voluntary carbon market is that we're kind of picking up all the shortcomings that the mandatory systems had. And because the free market is way faster in fixing problems and way more flexible in kind of arranging trade agreements, that market kind of had a lot of uptake, while the United Nations and the Kyoto Protocol sometimes was a bit slow in implementation, also had a lot of environmental and social shortcomings that were quite easily addressed by the voluntary carbon market. The only problem with the voluntary carbon market in that aspect is that it is quite an unregulated space, right, in which actors are trading in credits. And those projects that are generating carbon credits are not always supervised well enough.
Jack, if you could give us a bit of an overview for you to explain to us how banks fit into this picture, because I know you have looked into the role of banks specifically in the voluntary carbon market.
Yes. So just to take a step back real quick and tell you a little bit about how we at CCSI, the Columbia Center on Sustainable Investment, got here. A while back, we did a piece on corporate net zero pledges. And that was really one of our first deep dives into the carbon offsetting and net zero space on a corporate level. And so we looked at a wide range of sectors that cover the whole economy to kind of look at how net zero reports are structured in the short, medium, and long term. And then importantly, and also relevant to this conversation, is how much they rely on carbon credits and carbon offsets. And we found that in general, across industries, there was a huge reliance on carbon offsets to achieve those net zero goals in the coming years. So that's kind of where we started. And then we also have written a piece on insetting and offsetting, and particularly as it relates to nature-based solutions, the shortcomings in those areas and the pitfalls and lessons that can be learned. So that's kind of how we got to this point. And then we had the great opportunity to collaborate with Carbon Market Watch on this project specifically, because after we had already looked into various other sectors net zero pledges, there was still the outstanding question of the role of banks specifically as it relates to the voluntary carbon market. And so banks can play a major role in the voluntary carbon market, and they already do in some ways. One, just like with other companies, they can have they can be a source of demand for their net zero pledges. So if there are any residual emissions, for instance, that they want to neutralize, they can purchase carbon credits, and then in their annual reports or in their sustainability reports, they can kind of use those carbon credits and compare them to their emissions to make claims of neutrality. So that's how they can do it, as an institution themselves. They can also have a much bigger role than just their own demand by offering carbon market related financing and services to their clients. And particularly in a market that's growing, I would expect the banks to be even more interested. But I think, if we look at the voluntary carbon market right now, I think it's valued at something around $2 billion, which compared to the industries that banks generally play a role in is extremely, nascent and small. But importantly, there's a lot of consulting firms and other analysts that project that the carbon market is going to grow massively in the coming years. So it's certainly a sector, an industry that the banks are keeping a close eye on. And I would imagine that if it grows to those massive potentials that some say it will, it definitely has a massive potential. And I think the more it grows, the more banks will be interested in participating, not only themselves, but also, with their clients.
I guess that means that they are not convinced to jump on it quite yet, but there is potential there. You said, is it because of the size of the market what is holding them back? Is it because the cost outweighs the benefits? Is it because of the skepticism, the scrutiny the voluntary carbon markets also have been in recent times under? Could that be the reason why there is a hesitation from banks?
I think there's many different things that are being considered. One is definitely the size. Like, it's a nascent industry. It's still growing. The potential for profit is still relatively limited as it is right now. But as I mentioned earlier, if it grows significantly in the coming years and it offers greater certain that banks will be looking at it even more closely. So our research was really structured in two ways. One was conducting expert interviews with people in and around the industry. And the second was looking through publicly available information disclosed by the banks on their position towards the carbon market more generally. So not just their specific holdings in credits, but also generally their perspective on the current market and the potential for the market. And so what it really ended up being was a story of risk versus reward. And in general, the conclusion was that current risk seems to significantly outweigh the reward of actually participating in the voluntary carbon market as a bank. And so one of the foremost risks that I'd like to discuss is reputational risk. And in the last months and years, the voluntary carbon market and specifically the underlying offsets have just been under severe criticism. It seems to me like every couple months there's a new report on the lack in credibility of credits or offset projects that aren't delivering the emissions reductions that they promised, or there are avoidance projects that it turns out wouldn't have been needed or aren't additional. So what I mean with that is that they don't provide the same carbon absorption that they claim to provide. And then, perhaps most importantly, there have been severe human rights issues with some nature-based solutions projects.
Are these projects that are under other types of carbon markets different from projects under voluntary carbon markets? For example, is the risk higher than another type of carbon market project?
I think in general what we could say is that in the voluntary carbon market, because it is so unregulated, you don't really have any government enforcement that tells you exactly how you should tackle those problems that Jack has just mentioned. For this so-called additionality, basically the project developer, the person who initiates the projects, really have to demonstrate that this particular project has an added value, right? And how you kind of justify that added value is completely subjective. There are so-called standard setters that are guiding project developers in the project setup, basically explaining the rules for that. But still, in all of those standards and methodologies, there are loopholes that allow for exaggeration or over-crediting. That would be a case where you just issue too many credits for a project and the project didn't actually reduce that much, but you just get more and more credits out of it. Without going into much of the technicalities, you're basically, the number of carbon credits that your project is issuing depends on a multitude of calculations, and those can be misrepresenting the reality, right? So by saying you have this plot of land and we're going to protect this plot of land and therefore we are avoiding these emissions from happening, right? You kind of have to prove a lot of things to prove that this forest or this plot of land really is endangered. But oftentimes, and that's kind of the essence of all the scrutiny, that is not the case, or at least there's no clear evidence that those emissions would have happened. And that is only one of the problems that you have with the voluntary carbon market, because you have, on the one side, you have the quality of the projects and the credits that is a bit of a problem. But you also have a problem with how those credits are used. So if I'm a company and I want to buy carbon credits to offset my emissions, really make that claim that my products or my services are carbon neutral, and I'm basing that, for example, on a tree planting project, then my claim is misleading because the trees that I'm planting will never last as long as the emissions that I have been actually emitting. There has been an EU-wide ban on carbon neutrality claims, unsubstantiated carbon neutrality claims on products and services. And I think that's really important to make clear that carbon credits are, and here it comes to the real objective of the voluntary carbon market, is to channel finance into good project, right? So it really is about identifying projects that need funding and channeling that money into those projects. And at the moment, we have the market has been hijacked by companies that are trying to make claims based on carbon credits.
If we take a macro look and a step back, if we look at how many companies and governments have, kind of made these pledges to use carbon credits and to rely on nature-based offsets moving forward, we don't even really have the space to be able to do that long term. When we look at the land that we have on the globe in its entirety, it doesn't suffice for the future demand that companies and governments are saying that there will be for these types of projects. And so I'm also really curious, to bring it back to the banks to see if that changes at all, because it's 2024 now. The research we were looking, or the publicly available information we were looking at, were mainly 2022 and 2023 reports. And it seems like in the last 2 years, there's just been so much pressure, so much criticism on the voluntary carbon market that I actually wouldn't be surprised if in the 2023 reports, the 2024 reports, 2025 reports, there are some significant steps back.
I think it's also true for a lot of other sectors. In our most recent corporate climate responsibility of 2024, we have also seen quite a trend in companies silently going back from carbon neutrality claims, not from the particular purchase of carbon credits, but from carbon neutrality claims, and kind of, stepping a little back because they understand that there's quite some reputational damage to be risked, right? Going back to that visualization of having a project that is issuing credits and then goes to a buyer that uses the credits, retires the credits, you have a very short supply chain. But what really happens is actually that the project is creating carbon credits, and then the credits are up for trade on the secondary market, and they're changing hands for an uncountable amount of times, and they're being resold, I don't know, maybe 15, 20 times before they reach the end buyer, right? So each and every person who has been holding the carbon credit until it is reaching its end of its lifetime is kind of paying money for it. So we have, as of now, we don't have any insight in the real financial flows of carbon markets. So like understanding how big the market really is would actually require us to understand how the transactions work. But these are all, and that's a problem of the unregulated voluntary carbon market. These are all non-disclosed. And I think that transparency in that regard really is a big problem. So if I connect that to banks, it is super interesting to see that banks, could help scale up the market, but at the same time, we wouldn't know how and what the impact of that would be.
Yeah, I think at least when it comes to what we've been looking into, banks aren't like tangibly responsible for what is happening on a project by project basis, but I think they certainly can influence it. And I think they already have done that. So one of the questions that we were interested in was exactly this, like what are banks doing? If banks are seeing that there's potential for engagement long term, what are they doing now to kind of facilitate that? So we looked into specifically, whether there are startups that are out there to kind of support / solve the issues that banks have been, seeing in the voluntary carbon market. And before I go into that, I actually pulled out a couple of quotes from some annual reports and from some publicly available information from banks, where they kind of talked about some of the things that they're seeing in the voluntary carbon market. So the BNP Paribas said, quote, "Voluntary carbon markets are still quite nascent and much remains to be done to increase their robustness and credibility." So that's a little bit of an overview. JP Morgan said the voluntary carbon market needs science-based and equitable criteria to ensure carbon credits represent genuine emissions reduction or removal. So that's really about credibility. And UBS said one of the main challenges in the voluntary carbon market is the lack of standardization, integrity, and transparency. Without clear standards for carbon credits, it can be difficult for companies to know whether they're truly reducing their emissions. So, that just goes to say that I think they're seeing the same issues that we're seeing. So then after we, identified these things, we looked into specifically the types of startups that they might be funding. There are two main things that we were looking at when it came to the startups in the voluntary carbon market space. One was to connect it to our research, whether it was being funded or backed by a financial institution. And the second, more importantly, was the roadblock that was being addressed or targeted by the startup we were looking at. And so we saw a wide range of startups in this space. There were startups that are specifically tackling the issue of trading of credits, that are trying to make it easier for buyers and sellers to connect. There were startups that were specifically advisory companies that are helping others, reach their net zero goals using credits and providing other market advisory services. There are verification and integrity startups. There are startups that are specifically working on credit ratings to kind of answer the question the question around credibility and whether the underlying projects are robust. And then interestingly, I've been seeing more and more also in the startup space on carbon credit insurance.
It's true also that the startups that are active in the VCM space that are mostly engaged with integrity are not funded by banks, right? It's more of the transaction and infrastructure.
From what we saw, I think that's true. It's tough to say on like a whole startup ecosystem because there's a lot out there. But the ones that we were looking at were definitely mainly about like the transacting aspects of the voluntary carbon market.
As opposed to that would be, for example, insurances and rating agencies that are really engaged with the quality of the credit. So kind of what we said before, like if we want the market to grow, we really need to make it happen with integrity, right, and quality. And as far as we could see from our small sample right now, the engagement so far with banks is that they're funding startups that are active in the VCM, in the voluntary carbon market, but not necessarily the ones that are the most active in integrity issues. If banks really, engage in the voluntary carbon market, what does that mean if the market grows? Like what does it mean that there's more transactions that are happening? More intermediary sellers that are keeping on selling those credits, or does it mean that actually more money gets into the projects? We need to make sure that the quality definitely dominates the quantity of transactions. Like we really want to have good projects that are creating tradable units on the market.
I think so. That's one for sure. But I do think there are some startups looking specifically at the question of, credibility and verification. And just to go into even more depth, I think one of the big things that they can do is make that information and that data accessible to buyers, right? Like if you only have information on like price and, supplier or other like very surface level information on the offset that underlies the credit, that isn't nearly enough to like give you a sense of confirmation that there is actual credibility behind that credit, right? Like what you really want to know as a buyer is where is this located? What type of project is it? The ultimate question is how certain are we that the carbon is being stored long term out of the atmosphere, and that it was reduced in the first place, not just avoided. So if you want a really rigorous, high integrity credit, like that's the information that you want to know. It's interesting, right? Because we're talking about whether banks are going to. It's kind of like a chicken or an egg kind of thing. Like it's will banks participate more, or will the carbon market increase its integrity and its credibility? And for me, it's clearly one over the other. I think for banks to actually be more involved and not just banks, but also like organizations across the board, there actually has to be, significant progress done in the voluntary carbon market specifically. And I think the biggest is, this integrity factor, this credibility issue, that there's just so much uncertainty around the products that are currently being sold there. We're also not incentivizing, a market where the environment is benefiting. And it's 2024, the clock is ticking. Like that is really the main question, is whether these credits are credible or not. And I think banks see that just as much as we do. And that's a big reason for why they've been staying away, because they haven't been seeing that credibility in recent years.
And I think also that's why it's really important to understand that the clock is ticking, right? We don't have much time, but if we're going to do, we need to do it right. So if those big problems that are still out there are not addressed, any engagement of banks, if it would even happen because of the problems, any engagement of banks would just blow the market like a balloon, and the environment and the people wouldn't benefit from it. So it's kind of this understanding that we need to hurry, but also we need to be thorough.
What I think is part of the issue in this whole carbon market space right now is how disproportionately large the attention is on the voluntary carbon market. Like, if we're really dedicated to making this offsetting space a last resort measure for residual emissions that cannot be avoided, it shouldn't be getting as much attention as it is. Instead, there should be a much bigger focus on policies, on business models that really incentivize and encourage the avoiding and reduction of emissions in the first place. So we can actually create a new economy that's built on something better, rather than, more of this business as usual style where we're trying to compensate for what we do. So if you want to find, like, more rigorous offsets do exist where you can be more certain of its impact, where you can be more certain of its impact on people surrounding the offset project in the case of a nature-based project. But those tend to be much, much more expensive. Like, when you have that peace of mind, that certainty that the offset underlying the credit will work, it generally tends to be more expensive, because much more work is going into guaranteeing that process.
And I think there are companies that are actually leading by example and really reassess their residual emissions, so the unavoidable emissions, that really try to also have this as a dynamic thing, right? Like, the unavoidable emissions of today might not be the unavoidable emissions of tomorrow. So kind of there are companies out there that really only buy carbon credits to kind of address this last bit. But the fact that you can also not do that, and that sometimes it is economically more attractive to actually invest in carbon credits than into your own internal decarbonization, that is kind of a design flaw in general corporate accounting and sustainability.
We have established that transparency is one of the main issues with this carbon market. And I would like to know how easy or how difficult it was in your research to look into things precisely because of this lack of transparency. Was this a factor at all?
It definitely was. And I think what makes transparency, or what made it most complicated, was the lack of being able to kind of compare the comparability aspect. Because if you don't, like, if transparency kind of, and by transparency, I really mean the availability of quantitative and qualitative data. So when we were looking through these reports posted by the financial institutions we were looking at, we were trying to answer a number of questions. One, whether the institution uses carbon credits to offset their emissions, whether there's publicly available information on the quantity of carbon credits purchased, and ideally also, geographic focus of these carbon credits. Where are the offsets that underlie them? Does the institution facilitate participation on the carbon market? Does the financial institution invest or fund startups in the space? And what's their official positioning regarding regulation and market infrastructure? So those were kind of the big picture questions we were looking at. And we were definitely limited to what the banks had out there. So some banks, they were all pretty clear that they use offsets either today to offset their emissions or are planning on using them in the future to achieve, for instance, their net zero by 2030 goals. That was pretty clear, like on a surface level, that they definitely are using carbon credits for their own purposes. But then it was a much different question. We had much more different results when it came to the quantity. So some were very specific and outlined exactly how many carbon credits they purchased, which is a start. It didn't really tell us anything about, the prices they purchased it at, where the geographic focus is, whether, and as a result, we also had no information, obviously, on the credibility underlying those credits. But it was a good step in the right direction to know how many carbon credits were being purchased. And in some cases, we had that information. Having had, experience looking into different organizations and past research, kind of across the economy, we then had the question of how are banks specifically involved in the voluntary carbon market? Because we know that banks' influence generally goes, far beyond the own boundaries of their own institution, right? Because of how they facilitate many other parts of the economy. So we looked at a sample size of 10 leading global financial institutions. We started with 10 because we think that it was a digestible sample size. It was easy for us to navigate the space of what they have publicly available, and we think that they're likely leaders in the space, and what they do would probably be adopted by many others or serve as a model for many others. So we started with 10 banks that were based in the West, including BNP Paribas, JP Morgan, Bank of America, Citibank, Goldman Sachs, Barclays, UBS, Deutsche Bank, HSBC, and last but not least, Standard Chartered. We looked at their annual reports. They often had sustainability reports and sometimes even blogs or similar sorts of shorter pieces with their position as it's specifically related to decarbonization and the use of offsets. For a carbon credit to really be used, it needs to be retired at the end of the day, right? Which means it's basically a stamp is put on it that says this carbon credit is no longer in circulation. It's done. The carbon has been absorbed. It's been purchased. It's been retired. It's out of the market. And one of my worries is that that process might not take place, or already doesn't take place that much. They often stay in secondary markets on circulation for a while because for various reasons, one of which is, the hope that the price may increase and that you could sell it for a profit. So banks are, they are capitalist institutions. They are trying to make money using their money. And so are other entities. So one of my concerns is that the secondary market will grow to this massive scale, but that the rate of retirement might stay the same, which is already pretty low, or maybe even decrease.
And also, if you look at the financial rate of returns in a certain financial market, and you kind of zoom out and you have climate change, that will create unpredictability and unforeseen weather impacts and kind of make it hard to trade any good, right? I think it's only fair to say that in the short and in the long term, banks and other financial institutions and basically anybody who engages in carbon markets makes sure that this is done right, because it will get worse and it will get more expensive anyways if we don't tackle that problem right now.
I just wanted to say thank you so much again for having me here today and to have this discussion about this important topic. Before we sign off, I want to throw a huge thank you to our team here at the Columbia Center on Sustainable Investment, specifically Reet Chatterjee, Paul Danoon, and Pareen Toledano. Without you, we certainly wouldn't be here today. So thank you.
Yeah, thanks. Super nice.
If you're learning and enjoying this podcast, please subscribe to our YouTube channel, where you can also leave us your questions about this and future episodes.